Hi, Mark. I made you. There we go. There's Bloomberg.
Hi there.
Hi, Mark. How are you, buddy?
How are you? Good to hear you.
You have some fans in here. Blake Morrow's a legend in his own right, and Blake follows your stuff. I always try and catch your segments on CNBC.
Wonderful. Thanks very much. Yep.
And I noticed last week, or I think it's when I invited you, you had a tweet with, I know you may want to start with what you have up here, but you had a tweet about the euro. And you said that, it could be a little shaky, and this was before the French elections, but it was still hadn't done anything wrong yet. So I'm pretty curious on what you're seeing here in the euro. And I notice all these different numbers. Is that Tom DeMark stuff?
Yes, it is. Yeah, no, I use a lot of DeMark indicators just for a counter trend type methodology that I overlay to just a basic trend following approach. So, I mean, I do a very traditional type technical analysis, methodology, but I also use a lot of counter trend tools. And so DeMark really helps me to sort of pinpoint the highs and lows. And so, not to go through a lot of this, but in general, when you see things like this green 9, you basically had 9 consecutive closes that are above the close from 4 days ago, and so you can run that on days, weeks, months, and in general, it gives you signs of exhaustion. And the last couple peaks in the euro versus the dollar, you've seen 9 counts right at the highs, and then also at the lows. And in this case, a more serious low, you start off with this what they call a 9 count or TD buy setup, and then you run 13 consecutive closes where the close is beneath the low from 2 ago. And once you have 13 of those, and then you get your official buy signal, what's called a TD combo or TD sequential. And so when I see these appear in unison, then oftentimes they can be very powerful in marking highs or lows. But, my theory on the currencies, at least for this year, is that the dollar should be in a peaking process whereby we see the euro and pound sterling start to turn up a bit more forcefully on a long-term basis, because a lot of these longer-term cycles have historically bottomed at about 16.5-year cycles. And we saw decent bottoms back in 85, and then we saw good bottoms in 01, 2000, 2001 in the euro. And my thinking is that we are on the verge of a longer-term bottom. Yeah, exactly. So you can see similar, the highs have been made in 92 and also in late 07, early 08. And so we should be close to a time, and I'm not saying it's right here, right now, but I think that in general, the euro should be setting up for a bottoming phase whereby we see a rally over the next 7 to 8 years potentially.
Yeah,
if the cycle continues.
I saw that 2025 year. Someone put out a tweet, that's actually looking at the euro going up until 2025. Maybe there is one more flush under par. Do you think that the parity guys can get one more? Finally. Is that what you're looking for here? Is that
I had come into the year pretty bullish on the dollar into mid-year, and then thought we would peak. And so obviously, things turned down almost right away, and it's been difficult. I mean, when I look at the euro, I was thinking that we could get a final flush. I'm not really enamored by the pattern all that much just yet. I still think we're within a downtrend, and for those that trade short term, I think that there is a good possibility that we turn down and at least pull back down under 108 and fill the gap and try to get down into 107. But obviously, the battleground is pretty set with regards to getting under 105.70 is a pretty clear intermediate term sell for the euro, thinking that we're going to go to par, in my view, structurally. And if we can turn up and get above, the more recent highs that we've seen over the last week, then you would also have to go with that on the upside. And that's more of a, an intermediate term breakout type, philosophy. So
it's
those
kind
looking
of
near term, I think it's gone. Go ahead.
It's kind of in the same position as gold is. Gold was turned back from weekly and monthly channel lines in the last week or so. And let me ask you this. I know you're a great technician. But, you know, guys like Mark Chandler and our own Greg
Yes.
Horvat, they used the 2-year and the 10-year note as a correlation with the euro.
Okay.
So I was curious what you were seeing if this bond rally is over and we get one more shot down in the 10-year note, rate yields up, prices down, while the S&Ps are blowing off to new highs.
I think there's definitely a possibility that that can happen. I mean, you've seen a lot of the bearish sentiment start to wane on treasuries as yields have pulled back a little bit. So I've been in the opinion that rates can still move up into the summertime, and then, you know, we see a pullback in the market between July and October, and that's a time when we can start to see that you know, the demand for treasuries come back, and we can start to see yields start to pull back. I think that, you know, right now the sentiment on the euro versus the dollar are very, very bearish, and we've seen that also on treasuries right near the peak, and that's starting to be relieved a bit. But when you look at the short-term pattern, I mean, the real line in the sand is obviously this 230 to 231 level. I never got any real buys from a DeMark perspective right near the lows, but it was an impressive move back up above this level. I'm a little more bearish on treasuries near term and thinking that we probably can start to move up, and that should also be bullish for financials. I don't really see any real near-term problems for equities outside of just being a little overbought, and you know, sentiment still seems to be very negative, and some of that might be to just the administration rhetoric and the scare that it's causing. You know, it's the same thing. I think we're into earnings seasons now, obviously, and the election, every major event that we've gone into seems to have been a chance to buy equities where fear has been elevated, you know, right up before the event started. And you know, the French election was really no different there. We saw, you know, right around the time of the 13th of April, there were a couple different cycles that had shown the chance that we could bottom, and we saw the equity put to call rise above 90 on that day, the 13th. And to me, the fact that equities really haven't seen any weakness, but yet the put to call really started to spike was a real bullish signal that suggested that it might be time to go back into stocks. And obviously, the breakout in the S&P, you know, in the last week has been. We've seen a little bit of a flight out of defensives, and we've seen structurally things have taken on a bit more bullish tone. You know, Russell 2000 has started to do very well against the broader market. And
leading.
From a DeMark perspective, I mean, we're still early with regards to any sort of peaking process by at least a few weeks. So I think in general, you know, we had a chance to sell off back in early March, and we just didn't really get there. We didn't hardly do anything. And so this consolidation near the peak, you know, 9 times out of 10, these tend to be very bullish type movements. You look at just the S&P weekly, and it's just tough to find much fault with this chart. You know, in my opinion, you know, momentum had waned a bit, but we just didn't do anything on the downside. The trends are still very much intact, and so I'm thinking at least another 3 to 4 weeks of higher movement. And there's some things I'm looking at in mid-May that could be problematic, but that's a good, you know, that's another.
You mentioned July through October. What do you see in that time frame that makes you think that people might come back to treasuries and equities may correct?
Yeah, it's just a little. There's a couple cycles that I study, longer term things that are coming due, and between July and August, and it also historically lines up with a pretty negative time for equities overall. And so, you know, I'm thinking that we probably see some type of a peak in mid-July and turn down with a secondary peak potentially either mid-August or mid-September, but the period between then and October should be pretty negative, and then we probably bounce into year-end. But until we see more signs of real deterioration, you know, I have more intermediate-term concerns about the market only based on most of the monthly indicators that I track, and just the fact that we sold off so severely into 2015 and turned a lot of these momentum gauges really to the lowest levels that we'd seen in years. And so the snapback rally has gotten momentum overbought again, but we're really nowhere near the levels that we saw back in 2014-15, and that goes not only to percentage of stocks above 50-day moving average and 200-day. I mean, the breadth was obviously much stronger a couple of years ago, and that's largely when the majority of the world also peaked out. When you look at things like the Bloomberg World Index and other things where, Europe peaked out in 2015, China did, and we're really not even back at those peaks yet with regards to the world indices.
Great point.
Historically, you look back at the major peaks in stocks, that being 2000, 2007, and these indices all peaked around the same time. This has been the first time that the majority of the world has already peaked, a lot of them in 2014, 15, but the U.S. obviously being the stronger engine of global growth, at least now, has continued higher and making new highs. But yet we still have little momentum issues. We only have about 60. Go ahead.
Could that be because of confidence in the U.S. dollar, which might be near the tail end, that just dollar-denominated assets are in favor? So you buy the dollar, you buy, equities, you buy U.S. dollar-denominated assets, and should we get that shift in the dollar, that could be a catalyst for a shift in trend in money flow?
That's likely. I don't necessarily use a lot of macro and or fundamental events and try to pretend like I can predict the sentiment shift.
That's
based
why
on
you're better
like
than
that.
me, Mark. That's why you're a better trader than me.
Well, I'm more of a swing trade. I position trade. I don't do a lot of day trading or real short term, but I have a view, 6 to 8 times a year that is very strong, and I try to stick with that and keep things on until they show signs of switching. And so I have always looked at the dollar index per se, which is 60% against the euro, as being still quite positive with regards to the longer term chart, but obviously signs of divergence, and we've seen a little bit of a sell-off, and if we start to break down, then I think you have to respect that and think that this probably is the peak. But we haven't gotten any real long-term sells, which I really thought would happen on a monthly basis, and really only need another push up, which would have severe divergence at that point and would be a chance to sell into the dollar and think that everything else is peaking. But you look at the euro on a long-term basis and the pound, and they're both still pretty nasty and ugly looking, but that's also the time that historically you start to see. I mean, the divergence is caused just by the sideways action that we've seen over the last couple of years, but there's really no buys here either on the euro, and we really need to go down one more time, and that would be a chance to really cover shorts and think that you get long and think that, all right, the cycle is likely going to start to bottom out. But it's just tough for me to make. I mean, I have the longer term cycles that I look at, but the short term obviously rules, and you want to adhere to that. And until you see sign of either more strength of the euro or more weakness, I mean, it's just range bound. And if anything, we're up near a level now where I would be a seller of the euro against the dollar, and really a buyer of DXY in general, and thinking that dollar yen could be starting to turn back up, and you have one last hurrah where rates and dollar both move up, and that gold probably is sold, and precious metals suffer, and then
maybe into a June rate hike by the Fed. What do you think, Mark?
I think they certainly have a window, particularly if stocks can hold up into then. It's been much more Dow dependent than data dependent, it seems. I mean, I haven't seen any real huge signs of strengthening across the board in the economy. If anything, the last month we've seen exactly the opposite, not only in the U.S. but across the world, where almost everything has sold off in unison based on, this is a Citigroup economic surprise index, and you look at this and the global looks the same way, where things were very strong since the election up into March, and then we got a couple DeMarc sells, and we really fell off a cliff, and a lot of the economic data has actually been weaker than expectations in the last month. And so that's
a very interesting, you look at everything, Mark. That's
I mean, I try to have everything line up. I mean, I want to find things that are correlated the strongest, and that's where I think I can add some expertise, is when you see counter trend signals appear across the board on things that should be working, and then when they don't, and then you can add some value in thinking that. But the sentiment to me is, go ahead.
So talking about things that aren't working, the weak sector, and I think that there's at least a bear market rally coming, has been the oil shares. and oil.
Yeah.
Big break.
Yep.
And to me, it looks like we're setting up for maybe a rally back to 51, 51 and a half, which should help the market because S&Ps are pretty heavily weighted with oils, and they haven't helped at all.
Yep.
So what are you thinking here?
I agree with that. I think crude, as of today, is making what they call a TD buy setup above what they call TDST support. And so that historically has proven very actionable in trying to fade the move, which in this case is a downtrend from April as well as from early in the year.
Right.
I'm not enamored with the broader chart of crude, but for right now, it's really just a consolidation pattern, and you really can't make too much of this as being a meaningful top. And so, you want to see. For now, I'm a buyer of crude here, and I think that in general, energy, which has been the laggard and down 9% or so, and massively underperforming everything, likely can show strength. And it is a seasonal bullish time for energy, and in general, even though inventories are very high, you still see the dropping off that historically is coincided with energy starting to lift. So I look at a few different things, and one is I run charts of like the OIH versus the S&P, and so I run a lot of DeMark signals on everything to that regard, and you've seen a real capitulation in this on a daily basis and even a weekly. We're getting down on a relative basis to the lowest level we've seen since last year, and within a couple days of seeing buy signals on a daily basis. When you look at a weekly, you're still a few weeks away from seeing that. You got decent bottoming last winter, and we rallied also last fall. Now this shows that the OIH versus the S&P is probably 3 weeks away, and so I'm trying to find some evidence that we can bottom and start to rally. Still a little bit early from a traditional trend following perspective, but the move in oil should start to stabilize, and that in turn, could cause things to start to also trend up. But for the near term, I still think at 28 for the OIH. I mean, if you weaken down to 26, that's a big move, obviously. But we really need to see signs of reversing the recent damage that was done. We saw good buys early last year on a weekly basis, and my answer is that you have to be really selective at this point. That I'm more of a buyer of crude than I am for than OIH.
Than the shares. So I've noticed the same with the gold and the gold shares. And I was always schooled that the shares were the leaders, and they led the way. And gold shares haven't, especially the juniors, have not been really keeping pace with what happened with the gold on this recent rally. So.
Right. No, they've been extraordinarily weak, and I am still a little negative on gold mining and gold shares in general, and so you could probably get down to 21 from 2190 on the GDX, which for the JNUG is the one that everybody looks at for the junior or something. That's
that's
leverage ETF or something, but that. That's really interesting. That's gotten really beaten up badly, and so you're down to levels now where. This is a more interesting setup on the junior miners than it is for the GDX for me, and sort of an interesting spot. But given my thoughts on gold, my thinking is potentially you get one more attempted move up in gold, and then maybe that fail. We just never got any sells for gold here either, and so we haven't really broken down. Gold should be, really a couple days away from at least trying to have a short-term type bottom up here after this move, but we'll see if that materializes at all. So here we are, 1262. So you get down near 1245 to 1250, and you would think about buying it for probably a last, hurrah back to the upside, and then see. But as you mentioned, the longer-term pattern is still pretty negative, going back from 2011. There's a lot of overhead type supply, and if the dollar starts to turn up along with rates in the next month, then that should be pretty damaging for this also. So gold got right to pretty key resistance here, at least based on this trend drawn from 2011, and showing a few signs of rolling over. I think until more deterioration happens, and you want to at least initially be be a buyer, but that that also probably won't work if the dollars are going to turn up sharply along with rates. And so I try to make sure everything makes sense. And right now, you're slowly seeing gold start to roll over. And if my thoughts on yields and the dollar materialize for a little bit of a lift into spring, fall, and then a peak with peaking yields, and we'll see what happens in the dollar. But the dollar seems to be at a real make or break overall, and so it's really got to move quickly on a short term.
You mentioned the yen, Mark, and I'm interested. A couple of our team members are pretty positive on the yen. I'm wondering what your view is and where you think U.S. dollar yen could go to. You mentioned that it seemed to be turning up here.
Yeah, it certainly seems to be on a weekly basis. I mean, we need to see a little bit more to think that we're really there. Right now you look at, and I do make use of a lot of very elementary type trend lines, but when you look over the course of a few months' time, I think they're one of the more effective things you can use. I use trend lines and price and time more so than I use any sort of breakout or breakdown of commonly looked at momentum indicators, which I feel are very difficult. But if you have a 3 or 4 month trend line that's taken out, that can give you all the signal in the world. So I do lean on a lot of the classical type techniques. So above 113 for me would certainly be a big buy on the dollar versus the yen. I think the yen should see further weakness. I mean, today's inaction seems to have gotten this going a little bit more by the BOJ this morning. If you look on a daily basis, you see we got sells right at the peak, we got buys right at the lows on dollar yen. So just from a traditional chart perspective, I mean, you get over these prior lows, and so that really is going to involve, at least initially, 112.20 above that 113. That would mean you've got a big move coming in dollar yen, I think, to the upside. And so we're not there yet.
Maybe back to the old highs of 125, possible?
Yeah. I mean, next couple of days are going to be key, and I think you rally a couple of days, and then you sort of see what you make of it. Not the best risk-reward necessarily here, but I would still weigh in as positive on the short term. Longer term, you see, this chart that's really been ongoing for, multiple years, if not, the last couple decades with regards to dollar yen, and so I still have to sort of lean on that as well. And so that we really peaked at a pretty key level back 2 years ago in June, and we'll see if we get up there again and what happens. But obviously a break of this longer term trend going back since the early 90s would be hugely bearish for the yen, bullish for dollar yen, and I'm not sure if that happens yet. There's just not enough to go on. But
we'll see if it does it bigly, as our new president says, big league or big league. Mark, just one more question. What can you do? You have any view on the VIX, that we got that 25% drop, and the VIX? I've read that there's huge net short positions because they've been making money just selling any of the VIX derivatives for months and years now, especially since that spike on the Chinese devaluation a year ago. Do you think it's, I heard the same talk about gold when it was 200, that gold didn't work anymore. It's an archaic relic. Is the VIX broken?
Oh, I don't think it's broken. I just think you haven't really seen any signs of true fear in quite some time. I think you're seeing disgruntlement and frustration, and that's being seen by portfolio managers globally. But when the equity indices start to really break down, then you'll see a flight to where implied volatility is scooped up in bigger fashion. But you haven't had really any reason to do that of late. I mean, these longer term trends certainly have held just since last year. They've been pretty precise, and if you see a move back over 17, then we're going to get to the mid-20s, probably the mid-30s very quickly. And so that's going to take an S&P breakdown, which, based on some of the longer term cycles, I think the market should be in some sort of a topping phase starting this year in the next year. But, the advanced decline is right back at new highs, and you just haven't seen any sign of real, you've seen a little bit of deterioration in breadth just based on momentum, based on 2015 when I said, but there's just not a whole lot, and so if I start to see indices really break down, then you'll see your flight to quality. But to think the VIX when it got to 16 was going to start a big move up when equities were only at 23, 22 and the S&P, I mean, that's a little nonsensical. There's just no sign of any real volatility. We've been in this range where, I think the number of down days that have exceeded 1% thus far and this year has been fewer than we've seen in almost a dozen years. A colleague of mine, Ryan, what's his name, that went to LPL, he put out some decent stats on that and showed that the month of March had one, and it's basically been hardly any. So, we've been moving up since 09, and we've moved sideways really since mid-2015, even though the general trend has been up. But you've seen it's been tougher to make money just based on the sector rotation, and now you've seen volatility come to a standstill where the market goes in these violent 2 to 3 month upswings, and then you go sideways for 4 or 5 months, and everybody sort of scratches their heads, and then the next big event comes along, and people turn negative and draw down risk into the event, and that's typically a time to buy.
Yeah, because there is talk that people are not buying portfolio insurance anymore because they feel like it's a waste of money.
Gradually, people have gone more bullish. I think the one thing to lean on from a sentiment perspective that's really worthwhile to take a look at is the recent Bank of America Merrill Lynch, the Global Portfolio Manager Survey, and the one for April that came out, and it had some pretty interesting data. The most shorted, or most short on there was the euro, which was really interesting. The percentage allocation to equities in general has gone from about a 5% overweight back in January, February of last year when equities were plummeting, and now it's up to 40%. So that's definitely crept up. People are, begrudgingly bullish and invested. Yes.
That's pretty big, yeah.
However, the percent invested in U.S. stocks is a 20% underweight right now, which was the least it's been since 2008. It's all going towards emerging markets in Europe. And so for me, that's interesting just because I've seen some signs based on my own studies, and I pointed this out on Twitter, that, the Eurozone was starting to show real signs of acceleration versus the U.S., and there were decent signals of that, and that held true. France and Germany were up, 3 to 5%. And this is going back since 2015. If you pull it back on a longer-term basis, you can see just how long that the Eurozone really has been underperforming, really since 2007 when the majority of global assets peaked the last time. And so you're starting to turn, but it might have gone a bit too far too quickly just based on the sentiment, and everybody now thinks that the Eurozone is gaining steam. And so this is an interesting signal that when you use these DeMark signals, and they've come up now as 13 cells on the EZU versus SPY, which means that near term, Europe is likely a big underperformer in the next month, which means you short the VGK, you short the EZU, you short the FEZ versus being long the SPY against and thinking we're going to back off a little bit, and then you wait and see.
Mark, what a great interview. You opened my eyes to so many things. I really want to thank you for edifying the F.A.C.E community and accepting our invitation, and hopefully you'll want to return and we can do this down the road.
No, I'm happy to do this, and it'd be great to get more people. I'm hosting my own call this afternoon, and I'm going to give details on that on Twitter, but my own website is newtonadvisor.com, so I would encourage anybody that's interested to take a look at that.
Okay, so are you an
institutions RIA? No, I just run a consultancy subscription-based business. I started my business a year ago, so I work with a bunch of institutions, but it's also open to retail, and so anybody can get. I put out daily notes, weekly notes. I do a 5-minute video every morning that I send out to subscribers, and I also do a conference call, which just happens to be today at 1 o'clock. So I try to do it all as a one-man show and keep an eye on the markets at the same time. So.
I think your work is amazing, and I've interviewed over 700 people. So,
well, thank you very much. That's a great compliment, Dale. I appreciate it.
And I want to encourage people to check Mark out if you're in the stock market, and you could see that I asked Mark everything, and he answered everything. So so he's got the holistic view of everything that's going on. Check out Mark Newton. His Twitter is at Mark Newton CMT. What's that? Certified magician technician.
That's exactly right.
What it is?
It means I have my own 8-ball, and sometimes it works and sometimes it doesn't. But no, you have to shake it extra hard. Yeah, no, I have. So I have a private website for subscribers. It's under Newton Advisors, but the one for the public is Mark Newton CMT, and I try to cover the global macro environment, meaning technicals on stocks, commodities, currencies, and treasuries, and just give my my view and 2 cents as to how I see the world.
Your analysis is very edifying. Thank you again, Mark. My trading warrior brother. May this year be your best ever.
Thank you, sir. Well, I'm happy to join you whenever you'll have me. So I appreciate that. Have a great day. And thanks for everybody that's joined.
Okay, everyone. That's Mark Newton. One of the better interviews in the first month that I've been here at F.A.C.E. I hope everyone enjoyed it. And we'll wrap up the week in my first month at F.A.C.E. tomorrow. Everyone have a great afternoon, great evening, depending upon your geographic location. This is Dale Pinkert signing off from F.A.C.E. And remember, don't just count your pips, count your blessings. And we'll see everyone tomorrow to wrap up the week. TGIF, my trading warrior brothers and sisters. Adios.